Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello friends. Today as I record this video on Thursday, the European Central Bank, the ECB, has just announced a 50 basis points or 0.5% rate hike. This is their first rate hike after 2011. In a side note, a much smaller development, though of course a noticeable one, was the South African Central Bank also raised rates by 75 basis points or 3/4 of a percentage point. In this video, I want to talk about why this development by the European Central Bank is a good thing. I'm Vijay Bhambhwani. I've been trading these markets since 1986, and through my videos, I want to reach out to my online family and friends and help them get better returns on investments, both in their trades as well as their portfolio investments. So let's dive right in. Before you go, what? Have you lost it? You've been saying rising cost of funds is not really good news for equities, and now you're captioning a video saying the European Central Bank raising rates for the first time after 11 years is good news. Now, before you flip out, allow me a second and I'll explain to you why I'm saying what I'm saying. You see, so far, the US was raising rates. The Federal Reserve in the United States was raising rates. And I've explained to you before what the cash carry trade is. If country A is offering 5% interest and country B is offering 10% interest rates, money will flow out of country A because it's giving only 5% and flow into country B, which is giving 10%. This is called the cash carry trade or the cash carry arbitrage, interest rate arbitrage. I also told you that other countries will also be forced to raise interest rates because they will want the money which is invested in their country to remain there and not fly out to the United States. That's finally happening. So my 360-degree worldview of the financial markets, which lays out a broad blueprint, is basically panning out along expected lines. And normally what happens is the country that raises interest rates and witnesses foreign inflows sees its currency strengthening because foreign money is coming in, which is what was happening to the US dollar index or the DXY. Now the DXY was rising, which put pressure on other asset classes, particularly emerging markets, in which India is also a part. Now, why do emerging markets suffer a downward pressure when the United States dollar is strong? Simply because we tend to settle all our international trades, especially purchases of crude oil and natural gas, in US dollars. And all other factors remaining constant, even if the price of oil and gas does not change in the overseas markets, but the dollar becomes stronger, the landed price of those imported goods go up. This results in imported inflation. Now, if the US dollar falls, which it is after the announcement of the European Central Bank raising interest rate, there is competition to the US dollar. The euro is beginning to find support against the dollar and attempting to go above parity levels. It had fallen to parity, means 1:1. If the euro starts to strengthen against the dollar, which means the dollar is going down in the global basket of currencies, it will grant relief to the emerging markets back, including India. Will it force the European Central Bank to raise rates in the coming September meeting of its central bank also? There is a good probability it might do so. Now that they've bitten the bullet and raised rates after 11 long years, there is a good probability that to tame inflation, they will continue to raise rates, which would mean that there will be competition even in the future to the dollar's strength, which is good for emerging markets, including India. What we do need to watch out for is whether the Reserve Bank of India's Monetary Policy Committee, or the MPC, which is meeting in the first week of August, also follows suit and raises interest rates or not. That will be a domestic issue. And if you've seen my previous video, wherein I've talked about why Asia will lead the recovery after the winter of 2022 is done and dusted, once the markets have bottomed out and the bad news is factored in, I'm presuming there is no other war, earthquake, act of man, act of God coming in and disrupting the markets in the future. Once the dust settles, winter is over, maybe around November, December, this is why the Asian market will lead the rally. We are like mid-caps. We fall hard, we fall fast, but we also bottom out and rise much more faster than the large cap economies, which is Western Europe and North America. On this optimistic note, I bid goodbye to you and suggest you stay patient, watch the next few months, wait the next few months out, remain invested, but don't get too aggressive. And on this optimistic note, I'll bid goodbye to you, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Good, bad or ugly, I always look forward to your feedback in the comment section. Also, help me reach out to fellow smart investors like yourself by referring my videos to your family and friends. Thank you for being with me in my video and your patience. Till we meet again in my next. This is Vijay Bhambhwani signing off for now. Have a very, very profitable day. Thank you.